All right, so buckle up, everyone, because today we're taking a deep dive into a topic that I know can be a little scary, but is super important.
Yeah, definitely fascinating, that's for sure.
We're talking about stock market crashes.
Oh,
We're going to try to make it fun.
okay.
We're going to try to make it interesting, and we're going to try to learn some stuff.
I'll do it.
So we found this amazing YouTube video.
Cool.
It's called I 5 peggiori crolli di borsa della storia, which translates to the 5 worst stock market crashes in history.
Okay.
And it's from this Italian channel called La Zona di Interesse Risparmio e Investimenti, which means the area of interest savings and investments.
Okay.
So our mission today is to kind of dig into the stories behind these crashes and hopefully extract some valuable insights, for everyone listening.
Yeah, that sounds good. It's funny you say that because stock markets, they tend to climb upwards over time, but these crashes that we're talking about, they're like these sudden earthquakes that kind of shake everything up.
Yeah, the video even starts out by saying that. It's like, okay, stock markets generally go up.
Right.
But then the fact that they go up makes the crashes even more, like, nerve-wracking.
Right.
It's like this tension, like a rubber band. It's stretching.
And you just don't know when it's going to snap.
Yeah. Exactly.
That's a great analogy. And what's so interesting about these crashes is that even though we know they're like a part of this economic cycle, it's impossible to predict exactly when the next one's going to hit.
Yeah.
And it's that uncertainty that makes it so like, I don't know, gripping.
Yeah. And I think that's why people are so fascinated by them. Like, it's that fear of the unknown.
Totally.
So, okay, so the first crash that the video talks about is the granddaddy of them all, really.
Yeah.
The one that everyone knows about. Black Tuesday, 1929.
Yeah, the one that still gives investors nightmares. Almost a century later.
The video really does a good job of, like, setting the scene. They talk about this euphoric atmosphere leading up to the crash.
Right.
And everyone was, like, piled into the market.
Yeah, like it was a party.
Yeah. And people were buying stocks with borrowed money.
Oh, using margin trading.
Yeah.
It's crazy to think about it now.
It's wild.
Just buying stocks with money you don't even have, all based on this assumption that prices are just going to keep going up forever.
Yeah.
It's like setting yourself up for disaster, isn't it? What I think is really fascinating about this period is the psychology behind it. Were people just completely oblivious to the risks?
Yeah.
Or were they just like willingly ignoring them?
It's such a good question.
Yeah, it really makes you wonder if we're making those same mistakes today.
Yeah.
I mean, there's always that temptation to chase the next big thing, right?
Totally, yeah.
Especially in the markets.
Especially in the markets.
Yeah.
So, anyway, back to the crash itself.
Yeah.
So, on October 28th and 29th, the market basically imploded.
The Dow Jones, it dropped a staggering 13% one day and then another 12% the next. It's like falling off a cliff.
Yeah, and there's this term that the video mentions that I thought was really interesting. It's called the dead cat bounce.
The dead cat bounce.
Yeah. So basically what happened was after those huge drops, there was this temporary price surge.
Right.
That like tricked some investors into thinking that, oh, the worst is over.
Oh, like a false sense of security.
Exactly.
Yeah, that's a pretty common pattern in crashes, isn't it?
Yeah.
That brief glimmer of hope before things really spiral out of control.
Yeah. But in 1929, that spiral, it led to the Great Depression.
Yeah, a decade of economic hardship.
And the Dow Jones ultimately plummeted almost 90% from its peak. Like, imagine that, 9/10 of your wealth just gone.
It's hard to even fathom.
That's crazy.
And it took 25 years for the Dow to recover to its pre-crash levels. And that's even taken into account, the economic boost from World War II.
Yeah.
It just goes to show you the long-lasting devastation that a crash can cause.
Yeah.
It's not just about the numbers on a screen. It's people's lives and livelihoods.
Yeah, it's real people's money.
Exactly.
Okay, so let's move on to the next crash that the video talks about. This one is the 1973-74 crash. And they present it as being less dramatic than 1929, but still a significant event. What I found interesting is that it happened within the context of the post-war economic boom.
Right. So you've got this backdrop of growth and prosperity, right? But there are these cracks starting to show. The Bretton Woods system, which had stabilized global currencies for decades, had just collapsed.
Right. Yeah. And then boom, the 1973 oil crisis hits. I remember my parents talking about this, waiting in lines for gas.
Oh, yeah, I've heard stories. The oil crisis, it really amplified the downturn. Oil prices skyrocketed, which led to inflation, fuel shortages. It was just a perfect storm for the stock market. And what's interesting is that even without that drama of a single-day plunge like Black Tuesday, the effects were still substantial. The Dow Jones lost 45% and took 10 years to fully recover.
Wow. It makes you realize that these crashes don't always have to be sudden and dramatic to have a huge impact, right?
Right, exactly.
They can also be these slow burns that just kind of erode wealth over time.
It's not just about the speed of the drop.
Yeah.
It's the depth and the duration of the decline.
Okay. Now hold on tight, because we're about to talk about Black Monday, 1987.
This one is a real head-scratcher, even for, seasoned economists.
Yeah.
It came out of nowhere.
Yeah, so the Dow Jones plunged a massive 22% in a single day.
It's insane.
That's crazy.
Hard to imagine that kind of drop happening so quickly, especially because, from what I've read, things seemed relatively stable leading up to it.
Right. And what's even wilder is that we still don't have a clear answer as to what caused it.
Isn't that strange?
Yeah.
There are theories, about program trading and market psychology and global economic factors, but it's still largely a mystery.
So are you saying that something like Black Monday, a crash with no clear explanation, could happen again?
Yeah.
That's kind of unsettling?
It's certainly a possibility.
Yeah.
And that's why it's so important to study these events. We might not be able to predict them, but we can learn to recognize the signs of instability and manage risk accordingly.
So Black Monday is like this big warning sign, right?
It's a way, yeah.
That even when things seem calm, the market can turn on a dime.
Exactly.
But what's interesting is that despite this mystery, the market actually bounced back pretty quickly, recovered in under 2 years.
That's right. It shows how resilient markets can be.
Yeah.
But it also underlines the importance of staying calm during these periods of extreme volatility.
Right.
If you panic and sell at the bottom, you could miss out on the recovery.
Yeah.
Which, as we've seen, can happen surprisingly fast.
Right. Okay, so speaking of recoveries, the next crash on our list is the bursting of the dot-com bubble in 2000. And I feel like this one has some really interesting parallels with the tech landscape today, don't you think?
Oh, absolutely. The late 1990s, it was all about this, irrational exuberance around internet companies.
Yeah.
Anything with .com in its name was suddenly gold.
Yeah.
Regardless of whether it was actually, a viable business or not.
It sounds a lot like the hype we see today around certain tech trends.
Oh, for sure. Crypto, AI,
Yeah.
the list goes on.
Yeah.
But back then, all that hype, it created this massive bubble. And when that bubble burst, it hit the tech-heavy NASDAQ index particularly hard.
Yeah.
Hard.
The video actually highlights this difference. So the Dow Jones lost about 35% over 3 years, but the NASDAQ lost a whopping 80%.
Ouch.
Yeah, ouch is right.
And it took 15 years for the NASDAQ to fully recover.
Wow.
Many promising companies just vanished, wiped out by the crash. What's really fascinating here is that it wasn't just about the technology itself. It was about the hype and speculation that surrounded it.
It's like people got so caught up in the story that they forgot to look at the actual number.
Exactly. They were buying into a dream, not a business.
And it makes you wonder, could history repeat itself? Especially with all the rapid advancements in AI and other emerging technologies we're seeing today.
It's certainly something to keep an eye on.
Yeah.
We may be in a different era, but human psychology and market dynamics haven't fundamentally changed.
Okay, so let's shift gears now to a crash that had global repercussions, the 2007-2009 financial crisis. And this one was triggered by the collapse of the U.S. housing market.
Right. It all started with those subprime mortgages. Remember those?
Yeah.
Basically, banks were giving out loans to people who couldn't really afford them.
Right.
And then they bundled all these risky mortgages into these complex securities and sold them to investors all over the world. It was like building a house of cards.
So when the housing market started to cool and people began defaulting on their mortgages, the whole system started to crumble.
Exactly. Those securities, they became worthless. It triggered a cascade of losses across the entire financial system. And what's interesting about this crash is that it wasn't a sudden plunge like Black Monday. It was this prolonged bear market. So the pain was felt over a much longer period.
Yeah. And the video mentions that the Dow Jones took about 6 years to recover from this crash. But other indices, like Italy's FTSE MIB, which lost a staggering 70%, still haven't fully recovered.
Yeah, it's a stark reminder that the impact of these crashes can vary widely.
Yeah.
And some economies, they take much longer to heal.
It's like a global domino effect.
It really is.
When one major economy stumbles, the tremors are felt worldwide. So even if your investments aren't directly tied to a particular country or sector, a crash like this shows that you're not immune to the ripple effects.
Exactly. And it highlights the importance of understanding global economic trends.
Yeah.
And having a diversified portfolio.
Okay, so let's wrap up part 1 of our deep dive with the most recent crash on our list. The February 2020 pandemic-induced market drop. And I think this one was particularly unsettling because it was triggered by a global health crisis, something unprecedented in modern times.
Totally. The uncertainty surrounding the pandemic, the lockdowns, the economic shutdowns, it just sent markets into a tailspin. It was a really scary time. And what's interesting is that, in a way, this crash mirrored Black Monday in its speed and severity.
Yeah, the Dow Jones lost 38% in just a matter of weeks.
Yeah, it was a wild ride for sure.
It really was. But what's equally remarkable is the speed of the recovery. Within months, markets bounced back to pre-crash levels.
It's almost as if the market just took a deep breath, held it for a moment, and then exhaled.
Yeah, I like that.
The pandemic crash, I think, in a way, it's a testament to the adaptability and resilience of markets. It also underscores the power of government intervention during a crisis. The swift actions taken by central banks and governments around the world, they played a crucial role in preventing a deeper recession and supporting the recovery.
Yeah, it really shows how interconnected the global economy is.
Absolutely. And how important coordinated action can be in times of crisis.
Okay, so we've covered a lot of ground here, from the roaring 20s to the pandemic era. It's been fascinating to see how these crashes, while devastating, also reveal deeper truths about market dynamics, human behavior, and the global economy.
Yeah, it's like we're piecing together a giant puzzle.
Right.
But the pieces keep shifting.
Exactly. And it's up to us to figure out how they all fit together.
Absolutely. And maybe, just maybe, learn from the past to prepare for the future.
Welcome back to the Deep Dive. We're picking up right where we left off, exploring the history of stock market crashes.
Still digging into these market tremors, trying to understand what makes them tick.
Exactly. And before the break, we were talking about the pandemic crash and how, governments stepped in to try to stabilize things. It makes you wonder, what are some of the common threads that run through all these crashes? Are there any warning signs we should be looking out for?
That's the million-dollar question, isn't it?
Right.
If we could predict these crashes, well, we'd all be sipping margaritas on a beach somewhere.
Yeah, for sure.
But there are definitely some recurring themes that kind of give us clues.
Okay.
And one of the biggest ones is human psychology.
Oh, you mean like how fear and greed drive market behavior?
Exactly. Like when everyone's feeling super optimistic, prices go up, 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 even if it's not really justified by the fundamentals.
Right, right.
During those boom times, investors can get so caught up in this wave of optimism, they start thinking, this time it's different, prices are just going to keep going up forever.
It's like they forget that what goes up must come down.
Exactly. And when that shift in sentiment happens, fear takes over. Everyone rushes to sell, and prices plummet. It's like a stampede, everyone running for the exit at the same time.
Yeah, it's a pretty powerful force.
It is. It's this classic boom and bust cycle. And you know what often throws gasoline on that fire?
What's that?
Easy credit and leverage.
Okay, can you remind me what exactly those mean?
Sure. So easy credit basically means it's really simple and cheap to borrow money.
Right.
Which can be great for boosting the economy, but it can also lead to excessive borrowing and risk taking.
Okay.
People and businesses start piling on debt.
Right.
Often more than they can actually handle.
And they're using that borrowed money to invest in the market, hoping to amplify their gains.
Exactly. But as we saw with the 2007-2009 crisis, that can backfire spectacularly.
Yeah.
It's like playing with fire. Leverage, it magnifies both gains and losses.
Right.
If your investments go up, you can make a killing. But if they go down, you're in deep trouble.
It's a high-risk, high-reward game.
It is. And one that often contributes to those asset bubbles that eventually burst.
And it's crazy how even seasoned investors can get caught up in those bubbles.
Yeah, I know.
Do you think there's a psychological element to it?
Oh, definitely. There's definitely a social element to it, that fear of missing out.
Right.
When you see your friends and neighbors getting rich, it's hard to resist jumping on the bandwagon, even if you know deep down that it's risky.
It's like that herd mentality.
It is.
Everyone's doing it, so it must be okay.
Exactly. And the video also pointed out how new technologies and innovations can also trigger market bubbles.
Oh, yeah, like the dot-com craze, or even the recent hype around cryptocurrencies.
Exactly. We get so excited about the potential of these new technologies, we kind of forget to ask the tough questions.
Like what?
Like, is this hype actually justified? Are there real-world applications for this technology? Are there any underlying risks that we're ignoring?
Yeah. We get so blinded by the shiny new object, we fail to see the potential pitfalls.
And sometimes those pitfalls can be massive.
Right.
Remember the subprime mortgage crisis? That was partly fueled by these complex financial instruments that many investors didn't even fully understand.
Right.
They were essentially betting on a house of cards.
Okay, so we've talked about human psychology, easy credit, and new technologies as contributing factors to crashes. But what about, like, external shocks to this system?
Oh, right.
Things like wars, natural disasters, pandemics.
Those external shocks can definitely act as triggers.
Okay.
Especially if the market's already vulnerable.
Okay.
The COVID-19 pandemic is a perfect example.
Right.
It exposed all these weaknesses in global supply chains, healthcare systems, financial markets. It was like a stress test that revealed all the cracks in the system.
So you're saying that these external shocks, while unpredictable, they can kind of accelerate or amplify existing problems.
Exactly. It's like a house that's been weakened by termites.
Okay.
A strong wind might not normally blow it down. But if the foundation is already compromised, that wind could be all it takes to bring the whole thing crashing down.
This is getting pretty intense.
Yeah.
So if we can't predict crashes with certainty, how can we even begin to prepare for them?
That's the challenge, isn't it?
Yeah.
It's not about avoiding crashes altogether. It's about managing the risks.
Okay.
And navigating them effectively.
So what are some practical steps that investors can take to, like, protect themselves?
Well, one of the most important things is diversification.
Oh, right.
Don't put all your eggs in one basket.
Right.
Spread your investments across different asset classes, sectors, geographic regions.
So if one part of your portfolio takes a hit, the whole thing won't go down with it.
Exactly. If tech stocks crash, you'll still have investments in other areas to cushion the blow.
Makes sense.
Another important strategy is to have a long-term investment horizon.
Oh, right.
Crashes, they're often short-term events. If you panic and sell at the bottom, you could miss out on the eventual recovery.
It's like a riding out a storm, right?
Exactly.
Might be rough for a while, but if you have a sturdy boat and a clear destination, you'll eventually reach calmer waters.
I love that analogy.
Yeah.
And it's also essential to have a financial cushion, an emergency fund that can cover your living expenses for several months in case of a job loss or other unexpected event.
So that you're not forced to sell investments at a loss just to pay your bills during a downturn.
Exactly. It's about having a safety net.
Okay.
And it's always wise to seek advice from a qualified financial advisor.
Right.
Someone who can help you develop an investment strategy that aligns with your goals and risk tolerance.
So diversification, a long-term perspective, a financial cushion, and professional advice.
Those are some solid takeaways.
They are. But beyond just protecting ourselves, is there a way to actually capitalize on crashes?
That's an interesting question. Some investors, they actually see crashes as buying opportunities.
Okay.
When prices plummet, it can be a chance to pick up high-quality assets at a discount.
So it's like a Black Friday sale for the stock market.
In a way, yeah, but it does take careful research and analysis. You need to understand the company's fundamentals, its business model, its financial health, its long-term prospects.
Right. It's not about blindly buying anything that's cheap.
Exactly. It's about finding companies that have been unfairly punished by the market downturn.
So it's about separating the wheat from the chaff, identifying the companies that have a strong chance of rebounding. It sounds like a skill that takes time and experience to develop.
It definitely does. It's not for the faint of heart. But for those who are prepared and have the discipline to stay the course, crashes can actually offer unique opportunities for wealth creation.
Well, this deep dive is definitely making me rethink my own investment strategy.
Yeah.
It's fascinating how even though these crashes can be scary, they also reveal so much about human behavior, market dynamics, and the resilience of the global economy.
It's like we're peeling back the layers of a complex onion,
Right?
uncovering all the hidden forces that drive these events.
Okay, so we've explored the causes and consequences of stock market crashes. and we've talked about some ways to navigate them. When we come back in part 3, we'll wrap up our deep dive by reflecting on the lessons we've learned and how this knowledge can help us approach the future with a little more wisdom and a lot less fear. Welcome back to the deep dive. It feels like we've been on this roller coaster ride through the history of stock market crashes.
Yeah, from the Great Depression to the dot-com bubble to the pandemic crash.
We've seen how these events can really shake things up.
Definitely. But what's really remarkable is how resilient markets are. They always seem to bounce back, often stronger than before.
It's true. So as we wrap up this deep dive, what are some key takeaways that our listeners can apply to their own financial lives?
I think one of the most important lessons is don't let fear paralyze you.
Easier said than done sometimes.
No, right? But crashes, they're a part of the economic cycle. They're not a matter of if, but when.
So it's not about trying to predict the next crash, but about being prepared for it.
Exactly. Having a long-term investment horizon, a diversified portfolio, a financial cushion, these things can all help you weather those storms and come out stronger on the other side.
And the video we've been talking about really hammers home that point.
Yeah.
Don't panic and sell at the bottom.
Right. Because it's often during those times of panic that the best opportunities arise. Remember, a crash can actually create buying opportunities for those who are patient and have done their research.
It's like that saying, be fearful when others are greedy and greedy when others are fearful.
Exactly. But it's crucial to remember that investing during a crash, it requires careful analysis. Don't just buy anything that's cheap. Look for companies with strong fundamentals that have been unfairly punished by the market downturn.
So beyond those practical tips, what about the bigger picture? What broader lessons can we draw from these crashes about the nature of markets and the economy as a whole?
Well, I think they remind us that markets are complex and interconnected systems driven by human behavior, technological advancements, and global events.
It's like a giant tapestry, woven together by threads of fear, greed, innovation, and sometimes just plain old bad luck.
I love that. And while we may never be able to fully predict or control these events, understanding those historical patterns and the underlying forces at play can help us make more informed decisions and navigate the uncertainty of the financial world.
It's like learning to read the waves before surfing.
Oh, I like that.
You can't control the ocean, but you can learn to ride the waves and even find opportunities in the midst of the chaos.
I love that analogy. And just as surfers need to respect the power of the ocean, investors need to respect the power of the market.
Right.
It's not a game to be played lightly.
So in a sense, these crashes, as unsettling as they can be, they offer valuable lessons and insights. They teach us about risk management, the importance of diversification, and the need for a long-term perspective.
And they remind us that markets are ultimately a reflection of ourselves, of our collective hopes and fears, our ingenuity, and our flaws.
That's a humbling thought.
It is, and perhaps the most valuable lesson of all is that we can learn and grow from these experiences, becoming more resilient and better prepared for whatever challenges the future may hold.
Well said. And on that note, I think it's time for us to wrap up this deep dive into stock market crashes.
Yes, but the conversation doesn't have to end here. We encourage everyone listening to continue learning and exploring this fascinating world of finance.
Absolutely. And remember, knowledge is power. The more you understand about how markets work, the better equipped you'll be to make informed decisions and achieve your financial goals.
We hope you found this exploration informative and thought-provoking.
Until next time, thanks for joining us on The Deep Dive.